Modern portfolio theory is a framework for building investment portfolios that aim to maximize returns for a given level of risk. At its heart, this theory is all about diversification. It teaches us that individual assets matter less than how they behave together. Proposed by Harry Markowitz in 1952, it shifted the focus from picking winning stocks to managing the entire portfolio structure. The theory suggests that by combining assets that don't move in lockstep, you can potentially lower your risk without sacrificing expected returns. Unlike traditional stock picking, which focuses on identifying single winners, this theory looks at the portfolio as a single, cohesive unit. Adding more uncorrelated assets to a portfolio typically lowers the overall volatility, as the ups and downs of different holdings tend to cancel out. While it sounds like a simple cliché, this old saying is essentially the foundation of modern portfolio theory in plain English. Understanding these principles helps you build a more resilient financial strategy. Thanks for watching, and remember to keep learning about your investments.